Welcome back to EDS, and in this video we're going to take a look at how we can write options contracts, collect a premium upfront and generate a consistent return year on year. So the first thing you want to do is open up your brokerage platform. The one I use is Tasty Trade, but you can use whatever you like. And of course, we are going to be writing or selling options contracts, so we need to know where we are in the options cycle. And we can do that by coming over to the trade tab here, and we can just pull up any underlying. Let's just go with Apple. We just want to see a list of expirations basically. And there's two types of expirations that we can currently see here. We've got weeklies with the orange W, and then everything else is a monthly expiration. We like to go with monthlies for the purpose of this video, and we want to be about 45 days out in time. Anywhere between 30 and 60 days will do. So the next monthly expiration is October 18th. That's 14 days out. That is a little bit too soon for us. So we are going to go to the November 15th expiration. That's 42 days out in time, and that's much more suitable for what we are trying to achieve. So now we know 42 days. We can take this information, come over to our watch list, and we can simply filter out everything that has earnings over the next 42 days. The reason for this is because we do not want earnings to disturb our trade. Earnings can mess up your delta. It will almost certainly increase volatility, and all of these things are going to have a negative effect on your P&L. So as well as filtering out for earnings, you can also filter out any underlying that has a low liquidity level. The reason for this is we only want to be trading liquid things. We want tight spreads, and we want to be able to get in and out easily. So this is a futures watch list. We are not going to be covering futures, but by all means, we can just go to any watch list here, and we can just go down the list. So the only thing that we need to do now at this point is sort everything from high IV rank to low IV rank. We want to sell when volatility is high and play the contraction back down to the mean and potentially even further below. So we go to the top of the list, and we've got PDD, CCEP or Coca-Cola Euro Pacific Partners, and we want to keep in mind what we already have in our portfolio. So we've got an Australian dollars futures position on, we've got a crude oil position on, we've got SMH, UAL. So we're pretty nice and diverse in this portfolio, and you just want to make sure that you're not too heavy in any one thing. And just keep that in mind when you are looking at new positions to open. We've got JC, we've got Dollar Tree, AMAT. I do really like AMAT. Anything with an IV rank of 50 or higher is considered high, and anything with a rank of 50 lower than 50 is considered low. We want to stick to anything above 50. However, there can be times where anything above 30 can be considered acceptable. So if we just come over to a different watch list, we just want to pull up more things. This is what it looks like. You just want to keep grinding through the watch list and until you basically find something that you might want to have a look at. So I'm just having a look here. XLE, I believe we did have a look at XLE not too long ago. However, I think that the IV rank has increased since we looked at XLE. If we just go over to the chart on XLE, this is the position that we mocked up in the last video for XLE, and as we can see here, IV rank has actually increased since then. This original position would still be perfectly fine. We'd probably be in a negative P&L, but there wouldn't be anything to worry about because we're still within the range, we're still within the two strikes. But I think this would be a good opportunity to see if we can pull up another position on XLE now that the market has moved a little bit and that IV rank has increased a little bit as well. So XLE, it is an ETF. ETFs are really nice to trade, especially when they've got an IV rank of 68. So we already know we're going to be at the November 15th expiration. And now here we're looking at the options chain. This orange vertical bar is the expected move of XLE over the next 42 days, and this horizontal bar is where price currently is with respect to the strikes. So what are we going to sell? Where are we going to sell it? We want to sell one call, one put. Where are we going to sell them? I like to sell them at anywhere between a 15 to 20 delta, and that should land you outside of the expected move. So if we come over to the delta column here, as you can see, we've got a 17 delta here, which looks really nice. And then we've got a 16 delta on the put side. So 17 delta on the call side, 16 delta on the put side. That is delta neutral, near enough delta neutral. Technically, we've got a negative 1.33 deltas on this position, but it's fine. And as you can see here, our strikes are positioned outside of the expected move. And what that is going to do is that's going to lead to a very high probability of profit. So if you look in the bottom left corner, we can see here we've got a probability of profit of 73%. That's a very high probability of profit. And if we wanted to exit the position at 50% of max profit, we've got about 85% chance of that happening. So we're looking at anywhere between a 73 and 85% chance of success on this trade. Really, really good odds. And if we were to plot this on a chart so we can show you what's actually happening. So we've got our strikes at 85 and 102. So if you come over here to 85, and then 102 is up there. So this is what the range would look like. I do believe this range is slightly wider than the previous one that we had up, and that would be due to obviously the increase in implied volatility. But again, this is a similar range. It's a similar position to the one that we looked at last time. And this is a good example for anyone that's new, just to show you that it's all the same stuff. It's all the same stuff again and again and again. The product indifferent. It doesn't matter what you're trading, as long as you are implementing the mechanics correctly. It's all the same stuff. As long as you are sizing your positions correctly, you will be absolutely fine. So this is what the position looks like. And what are we doing here? So we want the price of XLE to stay within this range between our two strikes at expiration, which is exactly 42 days away. We've got a 73% chance of that happening. We collect $1.54 in premium per share up front. So that's $150 up front that we collect, because that's 100 shares per contract. And at expiration, if price stays between our two strikes, then we keep all of the premium that we collect up front, all $150. And that's basically how we make money out of this situation. Now, to open this position, our broker is going to require just under 1.1k in buying power, which isn't too bad. That does mean that we've got a return on capital of over 10%. It's an ETF, it's a naked position. This is a very nice return on capital for this trade. If this was a position that was slightly too big for your portfolio, by all means, you could just buy another contract a little bit further out, and just make sure you keep the width the same. So you're $3 wide on that side, $3 wide on the other side. Keep the width the same to buy a contract a little bit further out, and as you can see here, your buying power will decrease. This is no longer a naked position, so your probability of profit will drop a little bit, but you obviously do have a higher return on capital now. So that's how you can find positions, and that's how you can manipulate positions to fit in your portfolio. We did mention before there is something else you need to know, and that is the size of your positions. We've got a position sizing template that's free for everyone to use. The way it works is you enter in the size of your portfolio. Let's say if it's $10,000. Below, you will then enter in what the current VIX level is. Let's just say if it's 15.6. And then below that, everything will be automatically calculated for you. At this point, all you need to do is use the information here to form the backbone of your portfolio. It will tell you how much buying power to allocate to a single defined risk position, an undefined risk position, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow what's here, you will be just fine long term. To get yourself a copy of this, click the link in the description, head over to free position sizing template, and that will take you to where you need to go. If you do want to just copy our positions and make money with us and learn at the same time, again, click on the link in the description, head over to EDS Premium, get yourself signed up. Inside, you will have access to our portfolios, so you can just simply copy our positions. There's also a full course, so you can learn at the same time. It allows you to learn and earn. No prior knowledge is required. There's also a private community, so you can speak with myself and other like-minded individuals. There's a 100% money back guarantee. So once you've studied our full course and followed our trades for 6 months and you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now, it's £1 a month. The price will be increasing. However, once you're in, you're in. We have just started. That's why it's so cheap. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.